Good afternoon, ladies and gentlemen. Happy Friday, October 12th, 2018 to you all. Welcome to, of course, today's presentation, our Power Options Radioactive Trading Open Forum Q&A session. I've had an interesting couple of days, I should say, over the past, last Wednesday, of course, and Thursday. A little bit of movement up and then down and then up again today, closed on a high note. We'll have to be interesting to see what goes on Monday as well. Well, before we begin, we always want to introduce what is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options to find only those positions that match your personal risk-reward tolerance in a given strategy. Of course, we support over 23 of the most commonly used option strategies for the search and analysis. We do offer further tools to help you research the stock or the options, and of course do further what-if scenarios, and a powerful set of portfolio tools to help you paper trade, track, and manage your positions. In addition to that, we offer countless help videos, articles, blog articles, archived webinars, and more to help you get more familiar with the tools on the site and the various option strategies. Power Options was created in 1997. Everyone here on staff uses these tools to trade their personal accounts, so we have many more years of combined trading experience. Now, our process and procedures for this afternoon's presentation for our Friday sessions. When you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared inside your screen. Inside that platform is a question pod. Just use that to send us a question at any time during the presentation. And we're scheduled to be here from 4:30 to 5:30 p.m. Eastern Time. However, if we do have a high volume of questions, we'll be more than happy to stay online to make sure all questions are handled. And your questions can really be about anything related to options investing. If you have questions about general option strategy, how should I structure a covered call or a bull put credit spread or an iron condor? With this week's trading activity, you may of course have questions about trade management, rolling positions, waiting to roll positions, or what could you have done differently if you reacted instantly to Wednesday's move or even during Thursday's move. If you have questions about option specifics, how did implied volatility affect your trades this week? If we saw a spike in implied volatility that made it difficult to roll or adjust your positions, when might it likely settle and come back down to normal? Or questions about what is gamma, what is theta, what is vega? All of that is fair game. Of course, many of you might have questions about the tools on Power Options using the search tool or using the portfolio tools as well. That's fair game. And of course, we may have questions about the concepts of the limited risk trading technique, the radioactive trading techniques as well. All right, well, our basic ground rules for the presentation. Don't be shy. Ask any questions that you want at any time during the presentation. Be patient. There might be one or two questions ahead of yours. But as I mentioned, we will address them all during the presentation. I also encourage you to feel free to help us help others. If a question comes in and I give a response based on my market experience or what I've done in my personal account, but you have a different way of evaluating a position or managing a trade, I encourage you to share that with us, and we'll of course share it with the rest of the audience as well. I may ask you for clarification on your question. There's a lot of names out there for a lot of different strategies, jade lizards, double back forward spreads, double diagonals with a naked put twist, things of that. So I may ask for clarification on the position you might be asking about just so we're on the same page, and I can go forward and give you a second pair of eyes on your question, your strategy, or your potential adjustment you're considering, but at least knowing that we're looking at the same position and not something different. Most important, let's have fun. Let's get some good education under our belt, get ready for the weekend, and get ready to head into next week with some good ideas, some good thoughts, and able to withstand whatever the market tends to throw at us for next week as well. All right, all that being said, we're going to navigate over now to the Power Options suite of tools. I'm going to use these tools, of course, to help with the illustrations of the questions that come in. There we go. And what we're looking at here, of course, is a 14-day free trial. Those of you that are just getting started on Power Options, taking a 14-day free trial, I encourage you to take advantage of these 4 steps that are listed. You can jump in there and go ahead and get the quick start guide, a little bit of a PDF there to help you get started using power options. There's a variety of flash tutorials that you can use to get more familiar with the tools. We host a variety of webinars during the week and have a vast archive of recorded webinars as well. And any trial member or subscriber can schedule a free coaching session at any time. That is essentially a 35 to 45-minute phone conversation with myself or Ernie or one of the other staff members. We will walk you through the tools on the site and answer any questions that you might have. Okay, all that being said, we've got a couple of questions that came in today. As it came in already, I should say. Larry. Larry's, I think, from South Carolina, Larry, and Larry just chimed in and says, finally got power back. This is Larry. We had a scheduled session at 11 o'clock. Due to Hurricane Michael, unfortunately, his power was knocked out, but it's good, Larry, that everything is back on as well. Okay. Ziad asks a question. Why is the backtest tool only limited to a specific date in the past? Why not a range, for example, testing the whole month of August? Okay, now we do have, first, the way that I use the historical tools is I'll pick a strategy and I'll either have my saved search in that strategy, whether it's married puts or bull put credit spreads or covered calls, for example. And let's just go to bull put and we'll just go into the search as a starting point, Ziad. I'll give an example. And when I create a search on power options for any of the given strategies, it's based on the criteria that I'd be looking for, whether I'm looking at weekly options, whether I'm looking at monthly options, or anything along those lines. Here's our weekly bull put opportunities that came up, looking at the basic time frame, of course, the minimum net credit, probability more. You can see all that's available in the active filters menu down below. But I want to see how this test would have worked in August, okay? And the historical tool works the same way as essentially the search tool does. So if I want to go back in time, I want to say I would have found weekly bull put credit spreads on, let's say, August 1st to see how they would have performed. So I'll go to the Smart History. I'll go to bull put credit spread. I'll go to August. And let's just start, well, we'll start with August 13th in this case, okay? So I'm going to start with August 13th, and I'm going to select my default, the weekly bull puts. Now, when I run this search, it's going to show me any of the trades that would have matched my default criteria on August 13th, 2018, following the same save search I just started with the weekly bull puts. Now, this is designed to sort of work as how an investor would be trading. Now, it's not a portfolio backtest, Ziad. It's not saying that, oh, let me set stops on all of the various strategies, stops on the stock price, stops on XYZ, stops if the delta changes or anything like that. What this is designed to show you is what trades would have matched your criteria. I apologize, it's working a little bit slow. It's because right now the database is compiling today's history. It's just, that doesn't need to be there. Let me get that out of that. Okay, so right now we're plugging in all of the history from today's closed data as well. Let's get rid of that. There we go. All right, so on the 13th, we would have had about 7 or 8 total results. It's showing 12 because there were duplicates on the same stocks, but we've requested to only see 1. Now, if I decided to take a portion of my portfolio and I opened all of these 1, 2, 3, 4, 5, 6, 7 trades, what would I likely be doing? Well, I'd likely be tracking these positions as close to expiration as possible. What I'm testing here is to see, does this criteria make sense? Is this criteria successful over time, not considering what happens during the trade? So let me go ahead and hit calculate group results real quick. This might take a while, and what it's going to do now, it's going to show me what the return rate was for all of these positions. Okay, all of these positions essentially expired above, yep, the short put strike prices. So from that particular search on August 13th, all of these were successful trades. We are at 7 out of 7 for 100%, an average 8.3% return for 11-day trades from August 13th to the expiration on August 24th. Now, if I wanted to delve into each individual position, I want to see Tesla over that time. Using the More Information button, I can click on Analyze Position. This was a 322.5 to 320 spread. So what am I looking for when I go to Analyze Position? This is going to give me a breakdown of the entire position over that time. On the 20th, 4 days before expiration, something happened where it shows me the maximum return on the trade, naturally at expiration when everything expired, and the minimum return. So something happened at that time. You see the return here, minus 47. It dips down there at around 823, and then it came back up to be profitable, probably an increase of volatility. But further below, we can see the stock last price. And yeah, right around here, 822 is at 321. Would have threatened that short put strike price, and then it jumped back up above 322 to be profitable. Really took a hit here at 305. So right in here, between 816 and 817, probably opened 817 at 305, I would have maybe managed the position or adjusted it. But holding it through to expiration, we still got the profit that we wanted. Okay, so now what I would do is I know that these 11 positions I'd opened, if I'd held them to expiration, I can go through and see if I would have managed them and how I would have managed them. So we don't know what rollout opportunities you might have used, or if you would have just closed it if it broke through. You probably would have taken that 63, 64% loss at this point, which would have ended up being profitable. So it also gives you a bird's eye view of how many positions might you have closed that still ended up profitable to help you with your trading plan. But now what I'd do is I'd go back. Okay, so we know that we are this run from 813 to 824. And now what I do again is go back to the history and run it again. Because most likely I would have held most of those through to expiration. I wouldn't have opened any new trades until those were closed out. And then August 27th, Friday's expiration, the following Monday, 3 days later, what if I ran the same search again? What are the new trades that matched? If during that first run I only had 2 out of 5 successful trades, and then I run this next one just to see it, and it turns out that the trades we might have found on August 27th going through to maybe September 11th, September 12th, in that time frame, only 2 out of 7 were successful, or 2 out of 8, I'd already realized now that something's wrong with my criteria. Now I'd go back and start analyzing those individual positions from the first run to see what was wrong with them, what happened to them. Was the market pullback? Was it something else that happened there as well? Was it something in the background, or was I looking for poor stocks? Do I need to add some technical filters to look for better positions to create a better search that will appear to work better over time? Okay, so it's not doing a portfolio tracking, it's helping you to develop your search criteria. It's helping you to develop a winning search criteria. Here we have 15, the top 15, which I probably wouldn't enter more than 15. In fact, in the bull put spread portion of my portfolio, excuse me, Ziad, I only enter in about 3 or 4 of the top lists that come up on my search screen. But in any case, let's calculate those group results we would have found on August 27th and see how they would have performed going forward. Yes, it is a little bit manual, but this is more designed to help you to develop your search criteria so you can go section by section, expiration run by expiration run, to make sure that you can consistently make profits. And if your search isn't working, if you're not seeing positive results, that's going to give you an idea that you need to go back and maybe tweak some of these filters, maybe add some more technical indicators, up the probability or range out of the money, maybe up the open interest or the option volume. You know, I've got a couple technicals in here, stocks in an uptrend, looking for a positive MACD crossover. Maybe I change it to a stock list. Maybe I only screen against S&P 5-star stocks or NASDAQ stocks to help me with better choice selection rather than scanning across the universe of options. Okay? So how did our run work out here? Well, not bad. We had 100% on our first run, 13 out of 15 on our second, but the average return was minus 6%. It's the nature of credit spreads. We had 2 that hit the 100% loss on the trade. Even though we were right 87% of the time, we would have come out with a small loss. Now what do I want to do? I want to go back and check out those 2 that lost. I want to check out EA. I want to analyze the position. I want to see what happened, and I'm also going to look at the stock chart for that time frame to see if I saw any change in the technicals I would use. Did the MACD go negative? That might have been a stop for me. Could I have gotten out of it at a cheaper price or a less of a loss on the date when it went against me. So I'd look at the analyzed position, see what date the stock started to go bad. Okay, and at that time, when the return started to move against me, let's see, that's pretty big, that's huge right there. So when did it start to go bad? Right there, 8:29 to 8:30, 2 days after the trade. So I'd look at the stock chart then. You know, here we're still a little bit positive, and then it just sort of takes a hit. So what happened between 8:29 and 8:30 on this stock? Well, I was avoiding stocks that had earnings between now and expiration, so it wasn't that. Something else must have happened. So I'd look at the stock chart and see, was there anything that I could have seen around that time for EA? There we go. We'll go to big charts now. So around August 30th, here, now there's just a big spike down. The MACD was still positive. It didn't cross over. It broke below the Bollinger Band, and that's when it started to have that cross. Yeah. So actually right here, I can tell you I might have closed the position. Even though I just opened it a few days before, it was above the 20. When I saw it cross below the 20, and if the RSI was dropping here, but this really kicked it in. Okay, so it might have been too soon to miss that. But the stock came back up a little bit here. Of course, we would have been out of the position here at that point. So I might not have been able to avoid this, but I would go back now and look at the historical chain and see how to close it. Okay, so that's how we originally developed the historical tools, was as a means for you to check from expiration to expiration to see if, even if you're getting your win rate, are you getting the positive return that you want over time, and are they performing the way you'd hoped they were for this strategy? Now, all that being said, let's go back here for a moment. If you have a search already created that you want analyzed, you want to run it over a 1-year period, and you want to put some stops in, and you want to see if it would, you know, just run it through without anything, we can do that for you, but it's not a tool that's available. We do some of these analyses over 1-year periods, 2-year periods, and 3-year periods for customers, I'm sorry. And check out the Power Store, and you go to Strategy Testing and Optimization. The first test we run is completely different than that, but if you give us your saved search, what stops you might consider entering based on stock price or closing price of the options perhaps, there's other features that you can put in there as well. It usually takes us about an hour to run a year of data with just consistent running it, calculating the returns, and then adding in the stops to see if the stops worked or didn't work in your case, what would have been better, and we'll give you some basic ideas of the rundown, the end results, and what happened. But this typically takes an hour and a half to 2 hours of time, so that's $50 charge. We'll run that for you to do that. You can find that in the Power Store under Strategy Testing and Optimization. The optimization is different. We'll run a test, get your results, but then we'll further analyze it. Ernie or myself will further analyze it. We'll break down the different criteria. We'll do different runs based on criteria we would use to show you improvement, help you adjust the trigger rules by running multiple iterations of the search to see what performed better. And what we're going to do is we're going to take your results. We're going to guarantee that we can probably develop a trading plan based on the historical testing over that time frame that's at least 20% higher based on your initial results if they didn't match your needs to begin with. Okay, so we'd run the first for 50, but if you wanted to go more in depth, you wanted to see, hey, I still want to trade bull puts, but clearly I'm using the right criteria. Can you guys do any better? Well, we'd run many different iterations. It'd probably take one of us maybe 4, 5, or 6 hours out of the week to do that for you. Those are separate services. Those are separate tools because it takes us longer to do, and we have to actively analyze the data and work with the data and evaluate what would work better for you if you didn't get the results you wanted. But the backtesting tools, those are mainly designed to help you develop a search criteria, to see it from expiration to expiration, which is how you would likely be trading the strategy, rather than doing it and running it to that as well. Okay, so that's how the backtesting search works. And then, of course, also in the backtesting tools, you can always go into the search by symbol just to look one stock at a time, what bull puts were available on Apple on a certain date, or you can look at the chain as well for any date and time, and then scroll forward and scroll backward with previous losses, previous gains as well. Okay, so all right, that's how that operates, and I'm sorry it doesn't match your needs as it is right now that you've mentioned. It's okay. You find it cumbersome to do expiration to expiration and cycle to cycle and continue to change the date there as well. Okay, so hold on there. All right. Okay, so I just scrolled through. We've got a lot of questions that are here. We're going to take them one at a time. I'm not going to try to bounce around. I'm just going to go straight through. Sam says, good afternoon. He had a fantastic week with the puts, of course. Sam, the VIX calls we were talking about, my VIX calls for October 17th, they were at a loss as of Wednesday. I closed them out. Bought them at $1, closed them out at $4.30. The 16 strike calls for October 17th on Wednesday. So that countered the loss there, but you said you had profit there with UVXY. You mentioned that later. But you had a lot of nerve-wracking, it looks like, with some of the call spreads during this week. I had a gentleman call me yesterday who had his stock fall to within a couple points of his bull put spread. He had gone far enough out of the money for October 19th. The stock fell about 8 or 9 points, and I think it was at 142, and he was holding the 140 put on his particular stock. And he was really worried about it because he saw at his broker, of course, this was yesterday, he saw at his broker that it was an 87% loss if he liquidated the position. And that was, of course, the implied volatility spiked. So he couldn't close out his bull put spread even though it was close to the strike prices because he would have taken a huge loss. Today it settled back down a little bit. The volatility came down a little bit, and he's only looking at a 10% loss with a week to go, but the stock is now still 8 points to 7 points above his short put strike price. Okay. Following up with Sam's comments, he also says he's holding calls and puts for as far out as 4 to 6 weeks. He had to see what the market does next. It's going to maybe take a while to get a good gauge of what's going to happen next, but being in those sort of strangle positions can be lucrative. What we don't want to do in these volatile times is sell too soon and maybe cap the gain in one direction or the other if there's another turn or if there's an increase in a gap up Monday, excuse me. Rhajiv, he adds a comment, good afternoon, survived this week without any loss. Monday sold mostly Rickley position, was not aware of the volatility. Let me see here, and then I think there was a follow-up comment that came too later. Let me just take a look here. There we go. And tried to create a collar credit spreads as based on the weekly result due to the gap up and down, but not able to fulfill any. EA that we just looked at was 103 stock, short 105 call, and a put at 100. What we should expect on Monday morning if gap up or gap down? What will be the best strategy to fulfill positions? Well, if it's a gap up on Monday, I'm assuming the volatility is going to further lower. That means the bid-ask spreads will become a little bit more controllable. And if it's a gap up, the calls, though, they might start increase their premium also as more interest is going to the calls, but there still will be interest and activity to close the puts. I don't think I would problem that. If it gaps down, expect another volatility spike, expect wider bid-ask spreads. Closing, rolling, or opening anything might be difficult on Monday. I'm probably not planning on opening anything on Monday, by the way, just to see what happens. I'm not going to set anything on Sunday and look for new open positions. I've already got my management in place for the spreads, calendar spreads, bull put credit spreads, the married puts, and the straddles that I already have open. So we'll see there as well what happens. Okay. Okay, Larry was next. Rolling puts, your general rule. Now, Larry, I know you put in another comment here. I have to scroll down to that because we have to talk about what you mean. Okay, so you say a lot of puts making money right now. What is your rule generally? Okay, well, see, there's two different structures here. If I am in a static married put position, bought stock, bought a put, and holding a position here, the last few days, this put has gone up drastically. This one on Pulte has grown up drastically from 618 to 910, but it is a shorter term put. And that's really been, in the last few days, it gained another $4. So it already up in price, but it gained another $4 in the last 3 days or so. Should have bought a second put, but I didn't. That's okay. Now, if I'm tracking a position as a married put, and this one's closer in time, let me take Penn. Penn is an interesting situation. I bought Penn 10 days ago at 33 and originally bought the April 35 put for 420. It was a risk of about 6.5%. A few days later, on the 5th, I noticed a MACD crossover and I purchased the November 30 put for 145. Now this only gained 30 cents, but at close of Thursday, this was up $1.45 and this was up $3.25 and this was only down $4. So the two puts had combined it. Now, let me just show you the profit and loss chart. This is a subtly different position that you're in. But even if this is just standard married put, if I'm in this for the longer term, I was just holding the April 35, when would I look to roll the position? What are my rules of thumb? Well, that's for this strategy, that's discussed in the blueprint. And the income method I would use, what I typically look for, here we go. Let's go to a 1-month chart on Penn instead of 3. And I opened this back on about October 6th. Okay, so right around, no, it was before then, I'm sorry. It was 10 days ago, sorry, so it would have been the 2nd, my apologies. So right about here, near the peak actually, I got in at 33, right about at the close. Got it, no, I'm sorry, it was the day before. Anyway, got in at about 33. Had everything I wanted, just broke above the upper range, MACD positive crossover, RSI was positive, just went back above the 20-day, was closed above the upper Bollinger Band, and then it pulled back severely. When I saw that MACD crossover, this is when I bought the second put, the November 30, shorter term. Why the second put in November? Earnings are coming out on 10/28. I just wanted to protect it too there in case it still fell. And if it fell further and I had a profit on the position, even though the stock was down 25–30%, I may have just closed it and not even worried about going through earnings. Okay, so here it started to recover, but notice what hasn't happened. It hasn't gone back above the 20-day moving average. It has gone above the lower Bollinger Band, excuse me. MACD crossover has not been positive, although the RSI is increasing. I don't know if this is bottomed yet. It could go down another 45 cents on Monday. It could just kind of lose steam and drop back down. I don't think this is the right time, but what I'm looking for here is a bottom. Sort of what I would have seen if I was in the stock here, Larry, and we saw the stock continue down, and then when it crossed this 20-day moving average and it looked like it had a positive MACD and the RSI started moving up, I would have rolled down my put, made an adjustment here potentially, and that way I would have lowered my cost basis, been able to realize more of that upside movement the next 3 days later. That's what I look for when taking money out of the put. It's not just about a return on the put that's protecting the stock. I'll let this thing fall another 10 points because then I'm almost getting a 1-to-1 gain with the put. But when I see it turn, when I see it start to move back up and I have positive indicators that look bullish, that, okay, kind of tricked me. This all looked like a bullish move going forward there. Those 3 indicators looked really bullish, but then it faked me out. But that was okay. I already had the protection in place and added extra protection. At this point, I was actually at a small profit on the position, even though it was down 5.5 points from where I bought the stock. Okay, I followed the rules in the blueprint to that directly. I haven't rolled that April 35 put yet, and I haven't managed the November 30 put yet. I'm going to wait for the stock to go back above 30 and wait to see those indicators that I follow for when I would look to take the money out of the put. That's in a married put position. Let's say, well, let's just use the chain. Let's say on Monday, I opened what I might call a standard collar on Goose. It's down at 50.44. It was as low as 48.20, something like that. But let's say earlier this week, before this, let's say right on Monday, I'd opened a standard collar on GOOS. Okay, at the time the stock was at 54.29. Let's go back a day. Let's really hurt ourselves. Let's go back to that Friday the 5th. Okay, 56.96, up 91 cents. For this week's expiration, I'd have likely tried to sell the 57.50 just making up numbers here, but this is probably what I have done. Sorry. Let's call it $1.20 for the 57.50 call, and that looks better. 55, perfect. Okay, the 55 2.5 point spread at 60. It's giving up half of the premium to buy the 55 put. Okay, that's what I could have done on Friday. Yes, it closed. Let's take a look. I'm going to buy Goose, 100 shares, 56.96. Sell to open this week's 57.50 call. I know it's already expired. And buy the 55. I'm sorry, it's $1.20 and 60, taking off half. Let's see. First off, would I have done this? Maybe. It was a 1 week trade, so yeah, I would have done it. For 2% with only risking 2.4 for a 5-day trade, I would have done this. Usually with my collars, I'm looking for a 2.8% return, and my risk is around an average of 4.5% in the worst case scenario. Okay? Now, I know this is a bad example because it's a 1 week trade. We could make it a 2 week trade for next week as well. But again, at what point would I have rolled this put on this position? Well, with the type of drops that we had, let's just take a look. So we would have opened this on Monday, right? Bought the stock at 56.96. Let's go to a weekly chart. 5 days is fine. Go hourly just to keep it simple. Fantastic. So we get in at this week, obviously, at the worst possible price, 56.96, right about in here, somewhere during this time frame. Stock is falling, stock is falling. Here we hit the disaster on Wednesday morning. Okay, everything triggers. MACD negative crossover. Well, let's scroll down a little bit. There we go. Actually, that triggered a little bit before then, but the stock started to fall above the 20-day moving average. That's my warning sign. Here I'm getting a little bit nervous because it's now below the put. Would I have adjusted it at this time? Probably not for a 5-day trade because I haven't seen a confirmation yet. Now, this tanks here and here. What I likely would have done, and remember, I've got a 55 put and a 57.5 call that doesn't look like it's getting anywhere near there. I'm pretty much near full loss at this time. Would I roll the put down at this point and buy back the call cheaply and rebracket the collar? Only if it still gave me a 1% potential return without taking the risk up more than 4%. Rolling down at this point, trying to adjust the collar at this point, probably would have taken my risk for Friday's expiration or even next Friday's expiration to around 9 or 10% with a potential return of only 1%. If I want a 9-to-1 risk-reward ratio, I'm probably just trading a credit spread, not a collar. I still want to keep this near to 1-to-1 or 2-to-1, all right? Risking 4% to make 2%, risking 4.9 to make 2.7, okay? So in a standard collar, I probably wouldn't have adjusted this. I might have just gotten out for the 2% loss. It might have been less than that 2% loss because of the volatility spike. That put might have shot up in price. And yes, I'm losing on the stock 6-7 points, but the volatility might have helped that 55 put. And then the call, of course, is still out of the money. It might have spiked too, but at 57.5, it's probably okay to buy it back. So I might have just bought to close the call, sold to close the put, sold to close the stock, and gotten out with hopefully less than a 2% loss and not worried about it. Why not rebracket the collar? Because anytime you move down that put, even if you go out another week or 2 weeks to a lower strike price, you're going to reduce your cost, but you're going to increase the risk. Because the credit you get from rolling down the put, rolling to a lower strike, is always going to be less than the difference in strike prices. I can't roll down from the 55 to the 50 and get 5 points of credit. It would have only been 3. So yes, I reduced my cost basis by 3 points, but I'm getting 5 points less of a better payout. So it would have increased my risk. It would have gone up from 2% to 6%, then maybe to 10%, depending on what strikes I was looking at. So for a standard collar to me, Larry, that you and I have talked about in the coaching sessions, I typically don't try to manage it if it goes completely against me. If the stock's not right anymore, it doesn't have the signals I want, I'll just get out for the loss, or less than the maximum loss, 2, 2.5%, 3%, and then make it back later with the other trades. As long as I'm still making the consistent profits I'm looking for, being right 67, 68% of the time with standard collar positions, I'll make that back soon enough. Okay? If it's a long-term married put play, I look for the bottom. If it's a kind of different collar structure you're looking for, I try to catch the bottom by using those different technical indicators and fundamentals to get the bottom as well. Okay? That's sort of the rule. I don't have a rule that originally when I started radioactive trading, to be honest with you, what I would do in this situation, let's go back. I still have it here. Perfect. Let's go back. In this case on Penn, and I know we're talking about two different stocks, but in this case on Penn, I bought it at 33 and I bought the 35 put. And this only offers 5-point strike differences and standard monthly options. Well, okay, no, I'm sorry, it offers single strike differences, but I don't really pay attention to that. There's not a 32.50. Why am I bringing that up? Because in general, my original rule was, look, if I have the 35 put and the stock drops below 30, drops below the next available strike price, I wouldn't use 32.50 because that was essentially my cost basis, right? So if it dropped down to 30, or if it dropped maybe 7%, I might consider selling to close my additional put, buying to close a lower strike put to reduce my cost basis in that scenario. I really don't do that anymore because I've seen stocks that still continue down, and I wait for the bottom so I can maximize the value of the put. And by the way, if this happened and I decided that this is no longer a quality stock to be into and I don't think I can manage it, I would have just closed it. I would have sold to close the stock for a loss and sold to close the put, taken less than that original 5.9% loss. It would have only been about 2 or 3% because I still have all the time value remaining. Again, I'm okay with that. That's why I have the risk in the first place. There's a whole chapter in the blueprint that talks about exiting the RPM, when you should consider it instead of trying to make an adjustment. And of course, the whole chapter on the income methods discusses when and how you would look to roll the put in these types of scenarios. I didn't roll any puts yet, to tell you the truth. I haven't done anything to those existing ones. A couple of them are coming up in expiration. One of them I'm going to extend further out in time. But the others I'm not really worried about because they're really low risk or no risk to begin with. And then with Penn, I've already got the double put that I decided to go into. So I hope the stock keeps falling, actually. I make more of a profit if the stock keeps falling in that case. Okay. All right. So I'm sorry. So Larry, I think you might have answered the question you had later on. I'm scrolling through all the questions to see your other follow-up comments, but I think I got to all of them so far. I just want to make sure. Oh, yep, there we go. Good. So let's move to Guilleame. And unfortunately, I can't tell. I'll still answer the question for recording for posterity. But Guilleame asks, it says, first of all, thanks all for having these weekly calls. You're welcome. Obviously, with this market, very interested to know how to best adjust or not adjust when a stock drops 10% within a week of entering a married put. What about within a month? Thanks. Okay. So that's a very similar question. What if I had opened this stock? I had opened Goose as a married put. I do have it as a married put, completely different price numbers. But let's say I had opened this, and I would have used the April put if I'd opened it this Monday. We bought it at 56.96. I should go to the historical chain, but at 56.90, I probably would have gone with a 65 because the 60 would have been too expensive. Let's see what the 60 was on the 5th. Okay, so let's just go back to the chain very quickly on Goose. And let's go back to the 5th again. I can tell that the risk here would have been too high, even before the volatility spike of this week's crash. Had I opened a married put on Goose, most likely stock at 56.96, I would have wanted to open the April 60. Oh, that's terrible. At $10. That's going to be terrible. That's going to be way too much risk. Okay, but anyway, I probably would have had to go with a 65. So the midpoint was $10 on Monday. You know I'm not opening this trade. It's a 10.4% risk. I would have gone with a 65. Okay? Now, once again, but let's just take this. What would I have done in this situation? I answered it on Monday. Have a very high risk of 10%, higher than I like. I would have gone with a 65. I'll just say that again, but we'll stick with the 60. Bought the stock here. Put strike here. Stock wasn't doing what I wanted, fell below the 20-day moving average, but again, I use those three indicators when to think about rolling the put. Just because it fell below its 20-day moving average, I'm not worried yet, but I'm alarmed. Seeing the RSI decline, kind of alarmed. MACD crossover below the SMA 20, hit the lower Bollinger Band and decrease. Well, that all happened at once. Okay, so now here we are. When would I look to roll the put? Well, I had a feeling. A couple of you I see online right now, I talked to you yesterday, and I said that, yeah, I have a feeling we're going to bump up on Friday. I don't know if this is going to be permanent, though. I don't know what's going to happen on Monday. I had a feeling, though, that after the decline, we get some buying pressure and see a jump here. And this is hard because this is only a 5-day chart, right? It's not really extended. But when I use my 3-month chart, what I'd look for here is the bottom, right? If this came back up, but I think it's bottom, and it's now above the 20 again. It's almost hitting the upper Bollinger Band at the end of the day. Saw the positive MACD, saw this increase. This is where I might have rolled down. I might have sold to close the 60, bought to open the 52 sometime today. Would have reduced my cost basis drastically, but the risk might also have increased. Okay, that's what I'm looking for, is the bottom when it's down. This is more of a conversation I'll have for you soon after we have the members-only webinar on the 6 different ways to manage income method number 6 in radioactive trading. We'll have the Fusion and Blueprint members-only webinar on these types of income methods on adjusting the put. And I'll go more in depth. It's actually better in most cases to wait rather than to have rolled down to the 57.5, then rolled down to the 55, then rolled down to the 52, all during this 1 week, and now the stock's recovering right at 52. If I just done it when I think it's at the bottom and it starts coming back up, well, I'll use this as an example for that members-only webinar. We'll see what the exact numbers look like and why I'm trying to wait now instead of roll every time the stock hits a new strike price to the downside or falls 5%. I'm going to wait a little bit longer, try to milk the maximum gain out of that put I purchased before evaluating an adjustment. And again, I might not even do anything depending what my expectation is going forward. Okay. Don's been very patient. All of you have been very patient. We've got several more questions coming up. We're going to change gears out of the protected positions, which, by the way, everyone, just a side glance there. One of the benefits of collars, but specifically the married puts and the radioactive trades, is I felt no panic with these positions, 50% of my portfolio allocated to the married put radioactive trades. I felt no panic or need to have to adjust these positions on Wednesday and Thursday. I knew up front what my max risk was in the worst case scenario, and I wasn't there yet. I wasn't even halfway there in some of the cases. One of the cases I was, but I wasn't beyond the ones that are still further out in time that I'm still managing. I didn't feel the need to overreact or react with the market right away simply because I knew the floor, and if the stock kept falling, if the market kept falling, I could do other adjustments to profit on the downside, as we saw with Penn, or I still have a lot of time left to wait for the stock to recover or to wait for it to turn, then get the max value out of my put and move forward with a different put, whether it's different month or different strike, and that's what's described in the blueprint for all the different income methods and adjustments. Okay, so I just wanted to say that first. That's one of the benefits of controlled risk trading, collars, married puts, and even, you know, Sam would talk about the straddles and strangles, but he makes sure that every straddle or strangle he does only represents a small portion of his portfolio. In his worst case scenario, of course, if the stock's trading right at the strike prices, but he's 4 to 6 weeks out and he's managing in between. But as long as you have controlled risk, where even if a position goes against you for the full loss in the worst case scenario, it shouldn't represent more than 2 or 3%, maybe 4% of your total portfolio. Proper position sizing and having the right structure, vastly important. But we're switching gears now. We're going to switch gears from protected positions into something that some investors consider a protected position, but I kind of don't, because a lie of leverage works both ways. And that's not to mean anything negative, Don. I still trade diagonal spreads that you're asking about in my portfolio with a smaller portion, but let's get to your question. Don asks, with trading diagonal spreads, with leaps, all things being equal, debits and credits, is the probability better to trade expensive stocks with less contracts or cheaper stocks with more? From my experience, I am going to say not necessarily expensive stocks. I know what you're asking, but I am going to say sort of expensive stocks with less contracts. Why? Look at the structure. Whether you're using a leap, whether using a 3-month, 4-month, 5-month out, or whether you're even buying a 2-month out call and selling weekly against it to get 8 right cycles in between. Okay? Look at the structure. Look at the profit and loss chart here. This is just a basic view. We'll look at a better one in a minute. What do I really want to have happen with this strategy to be profitable long term? I want the stock to be trading at or near the short option strike price, or probably no more than plus or minus 1% of the short call strike price at that short option expiration. Stocks are going to fluctuate. What is this strategy really? This is one of the toughest strategies I feel, Don, personally, to trade. Why? Because whether I'm opening a 1-week out, a 2-week out, or even a 1-month out short call, what am I really saying? I'm saying I want to mimic stock ownership with leverage by buying a leap or buying a call. Some people refer to this as the poor man's covered call. I don't like that phrase. I've said it before why, but we'll just leave that alone for now. So I'm not buying a stock at 80. I'm buying a 70 call that's 6 months or a year out in time for $14 or $15, and I'm still selling the same near-term call against it. How can you lose? Well, you lose with a lie of leverage. But think about what we're really saying here. Even for those of you who are doing covered calls, what are you really saying? You're saying, I'm buying a stock that I want to see move up, but I want to sell premium, quote-unquote, rent my stock out, rent my leap out, okay, enter an obligation to deliver it 1 week, 2 weeks, or 30 days out in time. So I want a stock that's going to move up over the course of the year, maybe 10 to 12% in either strategy. But at the same time, in that 14, 15, 20-day cycle where I have this short call sold, I want it to hesitate. And then when I close that call, I want it to move up. And then when I sell a new call, I want it to hesitate. I want it to stay right around here. I don't want it to keep going up. Yes, my long call is gaining. So it's a short call. And you always get hit with the magic of the delta at or near the short option expiration. I'll get that into the minute. So why do I feel it's better to use higher price, more stable stocks? Because it is a neutral position if you think about it. It's a neutral to bullish position. It's not a big bullish position. It's not a volatility play on a smaller stock that fluctuates larger percentage-wise both directions. You want something that's gradually neutral to bullish, that still offers a good premium. That's where the search tool comes in to really help you with that. But let's just take a standard stock. I'm going to use McDonald's. I had a question about that with a bull put credit spread earlier today. I don't even know where the stock is right now or what the best premiums are, but I'm just going to take McDonald's. Okay? And I'm going to buy a leap. I'll use a leap. We'll go 220. And yeah, I don't want to spend that much, but I'm going to. I'll spend $155. I'll go with the $20 there. And I'm going to sell, let's give ourselves 14 days. Let me sell at $167.50 for $2. This probably has earnings coming up between now and expiration. So this isn't a good idea at all. This is not a recommendation. I didn't check that yet, but it probably has earnings between now and October 26th. Okay. Reasonable position, reasonable return. It is a 12.5-point spread. I got a 10% downside protection, didn't I, with this diagonal? Okay. But what do I really want to have happen? I really want the stock to maximize the benefit to be in this range, to be between, okay, I'll even be nice. I'll say between 165 and 170, good 5-point range. If it goes higher, I'm paying too much to buy this call back. If it goes lower, remember, lie of leverage works both ways. If this, now it's not too bad here, this view, but let's say it drops down to 157. Okay, that's about a 10% drop, probably about 6%, 7% of the stock price here. If I see a 6 or 7% drop in the stock price, even though it's a leap, it's probably going to be down 15 to 18%. If the stock falls 10%, I'm probably looking at a 30%, 25% loss on my leap. And that's what I'm invested in now, not the stock. I'm invested in this. I have an unrealized 20 to 30% loss. Yes, my call is declining, but it's well below the 1745 net debit. Leverage works both ways. Okay? So I want something that's stable to neutral, especially if I'm using a leap. That's where I'm going with this. If you're using a leap for long-term growth on a position that you don't want to pay in to buy the stock, that's great. I like the strategy. I'm a fan of the strategy. It can get hectic at times. But at the same time, I would look for almost a stock that you expect to grow 15 to 20% over those 420 days to January 2020. That's the nature of the strategy. Okay? But when you sell the call, you don't want to get caught in the jump. You don't want to sell a call around earnings. I won't sell a call in my diagonal spreads if it's around earnings and I'm still managing it. I'm in my third or fourth right cycle and earnings are coming up. I'll likely buy a put with the profits that I made and hold that through earnings as a straddle or a strangle. And then after the move, decide, hey, am I going to close my put now and keep this going as a calendar, or am I going to close the call and maybe keep this going as a calendar put because I still have that other put purchased? Okay, that's just my opinion. That's one of my approaches. Okay, so I think that's why it's better for a longer-term trade. Now, if you're just looking for near-term profits, you're not married to the stocks. You're not planning on managing them for 10, 8, 7 right cycles. Maybe use a lower price stocks that have more movement and more swing, but be careful because a near-term lower price stock can get you into trouble with sudden movements on the diagonal structure. An example, PHM. Oh, sorry. Let's clear that out. PHM, not the best stock to use. Doesn't offer as much options as you'd prefer. But let's say it's at 22.89. I can tell you this, I know for a fact. 2 weeks ago, 3 weeks ago, the stock was at 27-ish. So if I would have bought at that time, on November 23rd, which would have been about 60 days out in time, if I would have purchased the 25 call for around $3 and been selling near term, of course we would have been really high up there, of course we would have been about the 29 strike for about 40 cents. But let's just use those numbers. I bought this here for $3.50 or so. The stock was at 28, and we sold this for 40 cents at the time. This is going to look like a, well, sorry, I'm so sorry. Let's get the actions correct, folks. There we go. There's a diagonal. You see here, we're at a loss of almost 100%, 92% roughly. Our debit was 310. We're already at a loss of 276. Okay, maybe we would have managed it in there, but this happened over a 4 or 5 day period before what happened on Wednesday. Now, the other thing you have to watch out with these is in addition to that on the other side. It's not shown here on the graph because of the price selection, but this chart would start to do this, and you might actually have 2 ways to lose, potentially. This one wouldn't have been a bad because we used a 3-point strike, a 4-point strike difference, my apologies, and the debt was only 310. So this would not have dipped back down below the break even. But some positions will if you're trying to do it for too little of a premium, too short term against a 1 month or 2 month out call. And that's dangerous because these lower price stocks can move 4 or 5% and move back just as quickly. I think something, if you're planning on using the leap for long-term growth in this situation, you want to be finding a stock that is higher price, tends not to move as much, and if you do find the one that gaps up quickly, you'll be able to get that as there. Sam mentions that it's a trade-off in a sense here. I'm sorry, you had three comments there. Okay. There's Rose's comment. I'm sorry, I got to get to. Oh, there's Rhajiv's comment. Okay. Oh, Sam says he's selling calls and puts right now because of the high premium, and I think Sam had a follow-up on that in relation to looking at this strategy here. Okay, Rhajiv was offering. Okay, but what Sam was saying is that the idea is too is that the smaller stocks tend to have a higher implied volatility, which may look good, but even if you're buying a 5-month or 6-month out or 2-month out option, the implied volatility is higher as well. Okay, so you still want to find positions that match your goals. You still want to find positions that match the trend you want for the stock. But if I feel you're trading, by the way, you're going out in time with a leap, and you're planning on having 8, 9, or 10 right cycles against it over that time period, you're not just looking for that one instance, that one expiration cycle trade to try to get a 34% profit if it's within 1.5% of your short call strike price. If you're planning on managing it long term, you should find a stock that is neutral to bullish and matches the sentiment of the strategy. And I think you'll be better off with higher prices and fewer contracts, from my experience. I think the smaller price stocks, I mean, you could argue something like Bank of America, okay, for example. It is a higher price stock now. It's in the 40s, not really high, but it's not a $16 or $20 stock, for example. And there may be some very high cap stocks in the $12 to $20 range. There's a handful of them. Those might be okay. But in general, just by the structure of the trade and what you're looking to accomplish, I think the higher price stocks with a longer term bullish outlook will be more benefit. It's going to be more gradual. You're not looking to hit a home run. You're just looking to use leverage, but keep in mind, when something happens like it did this week, leverage works both ways, and some of the calendars I may have opened a few months ago, a few weeks ago, might be sitting at a 40, 50, 60% loss because of that lie of leverage. Sam's throwing out there today he actually bought stocks earlier, went back into SQ, NVIDIA, MU, DAL, WFC, and AMD. Yeah, I don't know about SQ. No, we'll have to wait and see. Okay, Rose says this was going back. I guess this was going back to collars, Rose. I'm not sure. Maybe it was talking about credit spreads, but he said, is it a good idea to just close the profit leg and leave the other leg? No, not necessarily. Okay. What do I mean by that? Let's take Penn. Well, let's just look at the chart for Penn. Okay. Let's say that when I open Penn, Rose, that I had bought it here at 33, which I did. But instead of buying that April 35 put and adding the second put later, let's say I just purchased the October 19th 31 strike put, and I had sold the October 19th 34 strike call. So here's my call, here's my put. Would have been a standard collar at these strike prices. Maximum profit up here, maximum loss below 31. So is it a good idea to just close the profit leg and leave the other leg? Now in a standard collar, remember I own stock, sold a call against it, and we own the put. If the stock's falling at this price and I say, oh, well, I've got about 100% return on this 31 put that I bought with the stock trading at 28, I should sell to close this put. Well, I can say it worked here, but what happens on Monday if it opens down at 27 and continues further? In this case, in the collar rows, both were profitable. The call would have been down to 10 cents. Let's say I sold it for 50. Well, it would have been down to 10 cents. This put might have gone from 80 cents to about $3. So if I close this put now and I buy it to close this call, that's great. I've got a lower cost basis on my stock, but now I'm holding a stock. I got nothing to hedge it. There's nothing there if it decides to go back down to 27, but at least I haven't capped the gain up this way. In a bull put credit spread, which we haven't been really looking at, but let's go back to the diagonal real quick. I'm sorry, folks. Let's go back to our diagonal real quick. And in this case, the only thing that's profitable is the short call, right? I'm losing hundreds of dollars of value on the long, but this has gone to zero. So should I buy this back and leave the long open? Well, it doesn't really help me, does it? I actually put 10 more cents, 5 more cents back into the position, but I still need to address something now that this is losing. And if I think it's going to recover, sure, I can make an adjustment. If I think it's going to continue to fall, I can swap it and go for a put, but it doesn't really do me any good to just close out the short right now and leave the long open. I need to do something with this because the long one's what's losing me money. Okay. Yeah, and Sam just points out that we're still 1,100 points down in the Dow there as well, just as a... Okay, I'll review that in a moment. And Rhajiv, you had thrown this in there. Okay, Larry says, okay, Larry, good, good. So that made sense to Larry, that our conversation, okay. Yeah, I'm not... Okay, sorry. Rhajiv, I think you had the next comment here. Hold on one second. Let's just go through. Okay. You say, is it possible to find a collar position where you have 1 week extra with the put and stock and sell a call a week earlier with the same risk reward? No. I mean, if it's there, it's going to find them, but you won't find them. Okay. This is what we call a dynamic collar. Anytime the timing is different, it's called a dynamic collar. So let me go to the long collar search. I don't have a default set up for you, Rhajiv, but I'll use one of the defaults as a starting point, and we'll go straight to the throat here. Okay, so what do I want? I want something that expires next week. So we'll go 2 to 9 days out in time. That's for my call. And for my put, I want this to be 9 to 18. You know, just isolate in there. Call expiration date less than the put expiration date. Okay, I want to change that. Max risk less than 1%. Now let's up that. It's in 2, and the max return greater than 1.5. All right, we'll try to isolate it in that fashion. I'll leave everything else just to see if we get any results. It might not be possible, Rhajiv. No, okay. So let's club this out. Let's go to 4 or less, and let's go to 2 or more. Got to give some leeway. That should have been there. Call strike greater than put strike. I apologize. Oh, I started. That's why. Okay. Still nothing. 2 to 9. That's fine. Maybe this. No, that's still fine. Call expiration date less than put. Yeah, that's what I want. No, I don't have much there else. All right. Let's take out all my ITMs and OTMs. By the way, it can read, what I'm showing you here is it can read for puts that are further out in time than calls. Let's see this. The 19th is silly. Out. All right. Let's make sure I have something right here. It can find them. The 26th is 14. 19th is 7. Oh, I'm sorry. I was trying to include it in there and I went too far. Okay. Well, no. It will find them. I'm just not sure what's keeping them out here. It's not call volume. It's not open interest. It's not put volume. I mean, there's just nothing that has a good return. Wow. Okay, well, this should be finding them if they're there. Let's clear it out completely. Call expiration date. Let's say 5 to 8 days, and this is going to be 6 to... Okay. Less than... I'm sorry. I know it can find it. I'll check for you, Rhajiv. It might be missing something. I'm not sure what. It might be wanting it to be 2 weeks out, and I'm not sure why. I'll talk to the programmers, but it should be fine. And let's just try the 2 weeks out, the 26. Actually, let's just go, 26, 21 to 28. Really? That's interesting. I'm going to look into that. It should be fighting. We should be able to do 1 week separation and 2 week separations from the short call to the long put. Not sure why it's not coming up with no other results there. I'll have to see if the programmers made any changes that I'm not aware of. Okay? All right. Okay, hold on. Let's get through this. Okay. All right, I'm going to take a look at this. Rhajiv threw something in. We are in our calendar discussion for McDonald's. I'm sorry, Rhajiv. Let me take a look at this here. Buy a 185 call. Okay, first off, I would never do that, but that's your idea. Buy a 185 call for 662 or whatever, 663. Okay, midpoint. And sell a 172.5 call for November. Okay. November which? November 2nd. 172.5 call. All right. So whoops. Sell that, buy that. Okay. Why don't I'm saying I would never do this. I don't buy out of the money leaps. Okay, I usually buy them in the money because I'm trying to mimic the stock ownership and I want a better delta and a delta ratio. Is this lower cost? Yes. Does it have lower risk? Kind of. But what is it? It's extremely neutral. Neutral to bearish, neutral to bullish. You're saying I don't want the stock to hit 172 in this case, and I've got a 182 and a 185 here. Now, two tricks on this. Number one, okay, some people say this is true, but not all brokers look at it. Some people say that if you ever pay a debit to get into the position, your broker will not require you to have a margin requirement. Not true in all cases, okay? This is essentially a bear call credit spread calendar. You sold the lower and bought the higher. I know that there are some brokers out there that will require you to have this difference in between, the 1250 margin requirement up. Even though you paid a debit, they're still smart enough to realize that, yes, you have a call that protects it at 185, but that protection doesn't kick in until it's above 185, and that's 12.5 points beyond this obligation. So they want to make sure you have the margin. If the stock suddenly spikes up to 180, well, this is still worthless. You wouldn't exercise the 185, the stock's 180, but you owe 750. You've got to buy that back for 750, or if you're assigned early, you've got to handle that. So that to me is why this is sometimes thwarted. Now for you, Rhajiv, it's probably not. Your broker probably says if you enter it as a debit, you don't need to do anything in that fashion. But I know for a fact there are those out there who will require this to have much. Sam just mentioned that too. And so that case, this is not the return you're getting. It's not based on the 524. It's based on the 1250 on the position, the margin requirement for the trade plus the debit. Okay? And in that case, to me, the risk is up here, though, not down here. Or the stock falls down here, the cost base is here, but the risk of the margin, that 1250, is up in this direction, not the other direction. So that's one of the things. You have to avoid the case of early settlement. Now, you're far enough out of the money, excuse me, here to where that, yes, this is a lower cost basis. But here's another problem with this that I have. When I look for a diagonal spread, I know you're focusing on cost, and I know you're focusing on return. When I enter a diagonal spread, I'm still neutral to bullish. And yeah, it's great if this short option keeps expiring worthless, but I'm neutral to bullish, so that long call, I want to have a higher delta. The short call, I want it with the smaller delta, so if the stock moves up, I'm gaining more on the long than I'm losing on the short. This is the opposite. The delta of your short is going to be higher than the delta of your long, so as the stock moves up, this is always going to be gaining faster, which is a negative to you, than this one is. Okay? Another kind of thing I always debate about this is, let me clear this out here. It's not going to be percentage-wise return, but we're talking about a max profit of 668 to me off of a true investment of, total cost is 524 plus the 1250. So I'm talking 1750, 1770, 668 max profit over a cost of 1770 in this case. Well, I wouldn't do it this way either, but parity trade, in theory, the parity trade to this is doing the same thing but with puts. Buy the November 185 and sell the 172.50. Now, I wouldn't do this because this puts in the money. I see what you're doing. Your start structure there, that diagonal is what would kind of be used for someone who's trying to attempt a double diagonal. Yeah, so this one doesn't give us really what we want. I don't know why, but it should. So we're getting 970 and 185. But technically, this is kind of a parity trade, right? You're selling the 172.50 put and buying the 185. It doesn't get the return though. But in essence, here's the problem. I think that margin requirement is closer to this. That gap, Sam says that gap is too big, but that's what I think would happen in that situation. Okay. So I'm not a fan of doing those out of the monies because it goes against it. I don't buy out of the money leaps, Rhajiv. I don't recommend doing it for my customers either. I appreciate that you're doing it. They're getting to see what you're doing, and this looks like a great risk and return. I think it's misleading because I think you would have to cover the margin in this case. That'd be an extra 1250. So again, this would be up to 1770 would be your margin requirement, and the return would be based on the margin requirement in that case. I don't like this because if the stock falls, you lose faster on the long option because it's already deeper out of the money. I also don't like the inverse delta ratio, which is what I look for. Okay. Wow. We can't give advice to this, but Sam says for anyone who's looking for the bearish side, you might want to check out WNC. Earnings is out. The stock lost 35 to the downside. Will probably still go lower. Also be kind of expensive. Okay. Yeah, Rhajiv says we've seen your structure before, Rhajiv. Now I'm not saying it's bad if it's working for you. It's just not something I advocate simply because it goes against 3 constructs of a diagonal spread that I use in my personal account. Okay. Now you're doing this with Guild, PFE, WMT before earnings and the week after earnings. What does he mean? Now I haven't looked at McDonald's, but what he's saying is that he's selling this out of the money call here and leaving this deep out of the money call far out in time, in this case a leap, where this was the 12th, right? Not the 12th. That's the 19th and the 26th. Is that what I used? Oh, you're using the November. Okay, so what he's saying in this case, similar to what he'd be doing, is let's say he sold the 19th, the October 19th call, the returns wouldn't be this high, and he bought the October 26th. Now, why he does this on a stock when the stock has earnings on, say, the 20th, 21st, 23rd, somewhere between the two. So the idea is the volatility might not affect this, and it might still expire worthless, so he's knocked down the cost basis. Now he has a cheaper call that's sitting out of the money here, and hopefully the earnings push it above there or push it down. But if, of course, the earnings are bad and it pushes down, you're going to be at an 80, 90% loss on that 2-week out one. And you're trying to play the volatility on that as well. Yeah, it's dangerous in a sense. Oh, you're sorry. It's 19% down, not 30, 35. I think is what you said. Okay. All right. Let's get to Rose here. Rose. I had a bull put spread for 1026, 1920, 1800. The stock is at 1789. I guess this is Amazon. Guessing. There we go. Or Alphabet. Let's take a look here. I'm assuming it's Amazon. Okay. October 26th, 1920, 1800 bull put. Bull put? Okay. October 26th. Okay. Oh, wait. Let's do that correctly. Okay. So this would have been a sell and a buy. Oh boy, okay. So two things on this first, regardless of what the price was here. Let's say it's $20. Now it'd be more. Yeah, it's about $20, I guess. So I'm going to cheat. This is going to look silly, but that's okay. Oops. Oh, no. Ah, I needed to reverse it. I'm so sorry. Wow. The price doesn't matter. I'm just looking for, there we go. Okay, a profitable trade there on the position. Okay, so Rose, you go on to say that you decided to take a big risk and close the long leg to receive some profit. All right, so you sold to close the 18 at some point for a profit, the 1800 at some point for a profit. I probably would not have done that. I would have rolled this down further. I would have rolled the short down at one point, even though it cost more money, because it might have lowered my return. It doesn't matter because it's below both strike prices at this point. I don't know when this started to go all the way against you, but what I likely would have done is if the stock had dropped below 1900 and looked like it was continuing to go down before what we saw in the last 2 days, I likely would have seen if I could have sold to close the 1800 and maybe bought to open a 1950 to convert your bull put to a bear put debit spread. That still would have been, if it still had a profit to the downside, if it was anywhere below 1920. Then you didn't even have to worry about it. It would have been done at a debit, but as long as the debit was less than 30 points, minus the original net credit you received, you'd be fine. Okay, but anyway, it's below there. My fear is that closing that long now, it might have been done premature. Yes, it recovered today. Yes, Amazon recovered slightly today. I think just about everything did. But at the same time, I don't like leaving the naked open. That's something I never suggest. When the stock breached below this, if I still had a bearish outlook, what I might have done is paid the high price to close the 1920 and let the 1800 run. I know you don't know at the time, but that was the direction of the stock it was going. You want something that's going to profit in this direction. When you close this, you're left with a naked put that still has increased risk to here. Even though you're okay getting assigned at 1900, I guess, I want to follow where we're going, or 1920, I'm sorry. I want to follow the direction we're going. I wanted to convert this to either something that was a bear put debit or just maybe even expensive long put position in that case. Buy to close the short, leave the long open. Convert it to a bear call or bear put debit spread. Well, use the pendulum adjustment to a bear put debit spread at that point, but left the 1920 open. And then had a lower return, but still just a return in this area. Okay, so going forward now, if you're assigned at 1920, if you buy it back, if you don't let it get assigned at 1920, you don't end up buying shares at 1920. Hold on one second, folks, sorry. But if you don't buy it back at, yeah, what is it going to cost you? Okay, what the cost on the position is going to be 1920 minus the current stock price. Okay, that's going to be your cost minus the profit you took on the long and the net credit. That is how it's going to work out. Intrinsic value. This would be your intrinsic value here. If you just buy to close it on the last day, it's going to be close to intrinsic value, but it might be $1 or $2 above it depending on what the market maker sets to the position. Okay, so that's what you're looking at there. Yes, to answer your question, that would be the closing price. The close to intrinsic value on the position, which is the strike price minus the stock price, and then minus the profit you took from the long put, minus the net credit. Well, yeah, I guess you could look at it that way as well. The problem is that the net credit is already taking into account the buy price of the option. Remember that too. Okay. Okay. Sam just mentions, why didn't you do a bear call and turn it into an iron condor? Yeah, well, I mean, now that it's fallen, if you think it's going to come back up, you could turn it, you know, do another side of it, do another bull put down here. But you got to manage this losing position first before you do anything. I wouldn't enter another spread on this yet. I'd manage this existing one maybe into a new spread as the bear put debit if it's possible to be profitable in that scenario. But yeah, in this case, I wouldn't try to open it as another leg spread, as an iron condor or anything of that nature, because it could still decide to swing other directions as well. Ziad says, can you please guide us on how you use the put or call percent IV range in your trades? Is it similar to the IV rank for the underlying? Yeah. What the percent IV range is showing you, Ziad, is where the option's implied volatility is now, the specific option that you're looking at. Where is the implied volatility now compared to where it has been over the life of the option? So it's directly related specifically to the option you're trading, not to 3 months of the underlying stock when your option might not have been released yet. If you're looking at weekly options, it's related directly to the option itself and how it has reacted. That direct option you're interested in trading, how it has reacted to trading ranges and trading spikes since it's been released on the market over the life of the option itself. So, in theory, when I'm selling, I'm probably going to want to look for something that has a higher IV range or higher IV rank, right? How they call it. So I probably want something maybe in the greater 60 percentile for the call and the put if I'm selling. If I'm buying, I probably want this to be in the lower 40th percentile if possible. Okay? That's as simple as that. Now this isn't a straddle or strangle, but that's how I use the implied volatility range myself. If I'm opening a married put, I typically look for the put implied volatility range, even if it's 150, 160, 210 days out in time, to be in the lower 50th percentile. When I'm selling my near-term calendars, I kind of like a higher implied volatility range on the option I'm selling, but I still look for maybe less than 50% on the leap option or 6-month or 4-month out call that I'm buying. So it's very similar to what they call the IV rank, but it's looking specifically just at the option you're trading, not against the volatility of the underlying stock over a 30-day, 30 or 3-month period, 90-day period, or whatever period they choose, when your option hasn't even existed in the market that long. Okay, we're looking at the actual option itself over the history of the life of the option since it was released in the market. Okay. Fernando, how can I simulate the worst case scenario with Power Options tool in order to plan time and point of adjustment? Well, I know that you mostly do married puts and some long calls and some straddles. You're looking into straddles as well. But it's just on the profit and loss chart. What we were looking at before, Fernando. I just closed all of them. That's okay. All right, well, let's find out. Whoops. Sorry. I'm going to go to pen again real quick. 2 things you got to know when you're analyzing your position, which I know you know, Fernando, is what is the worst case scenario and what does it relate to? Looking at this chart right away, what is my worst case scenario? My worst case scenario on the pen position is that the stock's kind of where it is right now, is if the stock's trading right at 30 on November 16th expiration. That is the absolute worst case scenario for this trade, the very bottom mark. Now, this isn't talking about to April. This is talking about just to November, the short-term trade, the shortest expiration, which is my focus. I'm going to have to do something by November 16th. And I have earnings coming out on 10/28. So I may adjust the April 35 put before then, but I'm probably leaving the November 30 right where it is. Okay? I'm actually curious. I want to see something here on this position. I didn't test it today, but now that it's come back to 30, I really want to know how bad it is if I do something very terrible for my long-term position. What if I sell this put I bought at 424 for about 630, and I buy another November 30 for $1.90? What happens to this position? How ugly does it get? Probably 12% loss? Yep, 12 even. Okay. So now, if I did that adjustment with earnings coming up on 10/28 from where the stock is right now, worst case is a 12% loss, lower break even 25.90, upper break even 34.10. Too wide for me for only 30 days. Don't like it. So I'm not going to do that adjustment. I want to wrangle more profit out of this April 35. Could have maybe sold it if I was smart enough and risky enough. Could have sold it yesterday and then today bought the November 30 put, and I would have gotten maybe close to $7 here and still paid about the same $1.75 here. It would have helped a little bit, but not a lot. Okay, but in both cases now, that's my worst case scenario. What if this is just my standard married put? Okay, well, what's the worst case scenario? It's if I hold it, sorry folks, one roll too many. If I hold it all the way to April, make no adjustments, and the stock is below 35, that's the worst case scenario at April. Okay, but here's the halfway point. What's the worst case there? Well, the stock's got to be about 29 before I'm at 80% loss. If the stock's trading just at 35 on January 16th, I'm still at a profit on this position. Okay, I'm not near the maximum loss. I'm at a profit. Okay, so this is what you're simulating here. You can see what your worst case scenario is, but it's based on the time frame. Now, let's take a chance. Pen's been moving against me. I bought the extra put. Let's pretend I didn't. And I'm sitting here in this Mary put and I haven't done anything. The stock's down 3 points from where I got in roughly, but I've got this position. I say I need to make some of this 420 back. Let me sell a 31 call for 7 days away. See, let me sell a 30 call. Okay, I want to get some premium even though the stock's right at 30. I want to get some premium because I'm worried about this position. What is my worst case scenario? To me, everything is. That's why I wouldn't do this. To the downside, the worst case scenario is if it's below 25. I take a loss of 140. The real worst case scenario is up here. You can see it on the graph. Where is the loss the largest? That's what we're talking about. And now, of course, if I want to say, well, what would my loss be if the stock did gap up to 40 at earnings? So I should be so lucky. Okay, well, I know earnings are coming out on the 28th, so I just put in 40. Oh, this only goes to 1019, but let's say it gaps up there. Well, I'm at a $457 loss. Not quite near I'm near the max loss, but not quite there yet, but still. We're at a reasonable loss of $457. We can see that on the chart. That's what we talk about with these strategies, with analyzing what is the worst case scenario. Look at it on the profit and loss chart. No matter how many legs you put into it, you can see what is the worst case scenario. What if it still falls? What if it's here? What is my max risk? Max risk doesn't always mean to the downside. Look at the graph. The max risk here is 640 to the upside. The stock goes to 50, 55, or 60. That's when I'm going to be at the worst case scenario. But none of these scenarios look good to me at all. Would never do this. That's why I typically don't ever sell. We never advocate selling a call below the put strike price because you cap the gains too much in that scenario. All right. One last thing Sam mentions is rather than a straddle in the money, is better in a big swing comes if you can have a nice trade, and if it's flat, then you can sell calls or puts and manage the trade that way. Okay, so Sam's saying almost similar to the calendar discussion we are having. If I have a 4 or 6 week out strangler straddle like he has, we hit that middle patch, of course, then you can sort of sell the calls and puts against it to sort of create a double diagonal in a sense, off of the straddle or off of the strangle. Maybe even a calendar butterfly if you want to look at it that way, depending on which strikes that you use. It's a way to manage the positions if you're in those straddles or strangles and, you know, rolling them up and rolling them down. Rhajiv has his one approach using the out-of-the-money calls that he buys, whether they're leaps or whether they're a few weeks past expiration. He's selling near-term before expiration to lower the cost basis, then looking at it, adjusting it after that fact. As I mentioned, because of what I look for with the strategy of calendars, I look for positions that I'm more growth-oriented on but don't want to pay the high price for. So I look for positions where I'm buying in the money to get to a, buying in the money and selling at or just out of the money for a higher debit. But number one, it removes any possibility of having a margin requirement because I'm guaranteed to buy the stock from a lower price than I might be assigned. And if the stock does move up, I still have that higher delta ratio where I'm gaining more on the long than I'm losing on the short. Until the magic moment of expiration, when my short call goes either to a delta of 1 if it's slightly in the money or 0, and my long option delta hasn't quite reached a delta of 1 yet. That's the tricky part at expiration, and why those calendars are hard to manage on the day of expiration. If it's slightly in the money and you need to roll it because it's moving 1-to-1 now with a stock, and your long option quite isn't doing that yet. All right, well, ladies and gentlemen, we are at 6 o'clock even. I don't see any other questions that have come in. I think, whoa, sorry, folks. I don't see any other questions that have come in. I think there's one that just came in as well. I'll check that in a moment. But just want to remind everyone, of course, today's materials are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. They're just ideas that I have based on my trading. And I was about to say I'm flawed. I'm not going to say it that way. But I learned from you guys just as much as I hope that you learn from me. I'm not saying there's anything wrong with Rajiv's approach in the situations where it works. He showed he had us build a diagonal spread with an out-of-the-money far-out call and a short-term just at or slightly out of the money that had, not including the margin, remember that, not including the margin, had like 120% return, okay? And that looks really good. The margin in it wouldn't be that high, but it was a 668 profit off 524, but we showed how the real investment would likely be around 1270 for the margin requirement in that case. But if that's a structure that you like, I encourage you to research it further. I encourage you to graph some of those positions. You don't have to trade the way that I trade. I just explained why I don't advocate what Rhajiv does, because in my mind, when I'm doing a calendar, I'm doing a specific structure to look for a positive delta ratio for my long divided by my short, and I'm looking for longer term growth on the position, not trying to find a 2-week out or 3-week out profitable trade, or with the expectation that my stock is going to grow 20 to 30% from where it is now over time. I'm really just looking for more of a gradual growth, and instead of buying the higher price stock and selling the calls against it, using that as a diagonal spread as well. So that's just some of the things. It doesn't mean that anything that I say that I think is a bad idea is a bad idea. I'm not even saying it's a bad idea. I'm just saying it's something that I personally wouldn't trade. Okay. And Sam brings up his comments on his straddles. He just threw in a comment here when IWM is at 170, but puts 120 days, and it took 3 weeks for the ETF to come back to 170 because the long time frame, it was not losing any decay. That's right. Leaps give you the slower time decay. That is an advantage. But you're selling lower strikes were going worthless for 3 weeks, and that was helping you pay for the position of it. So yeah, if I've got a long call or a long put that I bought because I thought the stock was going to move up and it tends to stagnate, that's the perfect time to sell directionals against it, as long as it stays neutral and it doesn't gap up above it. Okay, in that case, and the key time frame. You said you think Rhajiv, you mentioned that you said the idea for backtesting Rajiv's strategy there to see how it performs against others would be a good idea. And then you said that you think 60 to 70 day mark would be good. I guess you mean for the long option in that case, instead of buying a leap, buying the 60 or 70 days out for the long option when selling the nears against it. That was Sam's comments. All right. Well, ladies and gentlemen, I just want to remind everyone, if you some of the tools that we use today, the backtesting tools we started off with, we looked at the search a little bit for the calendars, but we looked for the collars and we didn't get what we wanted. And that's okay, I'll look into that. But remember, that search tool supports over 23 different strategies, things such as the percent implied volatility range and other criteria, delta ratio that were discussed today. You can test it out for 14 days. Just go to powerop.com, put in your name and email address, and you'll have access to the tools for 14 days. The subscription level starts at $40 per month after the 14-day free trial. And we, of course, do offer higher levels of service for real-time and the full access to the historical service, the historical data. That starts at $100 a month. That gives you the delayed service plus full access to the back testing where the data goes back to April of 2006, and that's $100 per month for that service. If you're interested in more free education, remember, check out the blog anytime, blog.powerop.com. As we usually discuss, you can go to the webinars page. It's just powerop.com/webinars.asp. All of our Friday discussions, recent ones, are archived under the requested topics tab. There's also several webinars under the Power Options Tools, Option Strategies sections, and Options Concepts tabs and categories as well. This week we'll have a live webinar on Tuesday for the role of the income methods in radioactive trading. That'll be Tuesday at 12 noon. Wednesday at 12 noon, I think we're going to look at using the portfolio tools for power options. We'll be back here, of course, at 4:30 p.m. next Friday. You can also check us out on YouTube. Just go to YouTube and look up power options. All right. Ladies and gentlemen, thank you for your time. Thank you for your questions. Thank you for your insight. It's an interesting trading week. We'll see what we have in store for us next week. If you think of anything else later on, remember, send me an email anytime to support@poweropt.com or support@radioactivetrading.com. Remember, you can also call me during office hours at 302. I should say market hours, not office hours. You can call us during market hours at 302-992-7971. And remember, trial members and subscribers, you can schedule that coaching session at any time. That's just a scheduled 35 to 45-minute phone conversation with myself and Ernie. All right, well, ladies and gentlemen, we'll see how our trades go next week. We'll see what happens next week, how the market pairs there. See if I make any adjustment. Depends. I look forward to seeing what Sam has to say about his positions depending on what we open with on Monday and Tuesday, or perhaps even switch by Wednesday or Thursday. It'll be interesting to see. But remember, if you've got yourself some protection, you've got yourself hedged, even if you're in leverage positions, diagonal spreads, bull puts, even just buying calls and buying puts, make sure you've got proper position sizing and not one position as representing, more than 5% of your portfolio or so that if it does go to full loss, which can happen quickly with these vertical spreads, diagonal spreads even and more, that you're not losing more than 5% or so of your total portfolio value to that one trade. I'll see you soon, folks. Have a great weekend again. Good night.